the proportion of all EVs users who will ultimately use the charging stations and how much they will charge per kilowatt hour are the next important points. And you already know that the bears will say something like, today everyone just charges at home, but they charge at their office better than expected. That's probably the best way to sum up Tesla. And it sucks. So Wednesday, for background, Bush analyst IVES is spot on with that one and thinks the EV leader still has room to run after its most recent optimistic Q2 delivery figures. In a research note, I stated that Tesla's record-breaking second quarter deliveries of 466,000 exceeded Wall Street's consensus estimate of 447,000. This also increased production to 479,700, which I believe is evidence of enhanced capacity and a healthier macro. However, at this point, they will likely be the only player in town, which is why GM, Ford, and other companies are investing in Tesla. I can believe that today's market is supercharged and charge. Batteries will come next, followed by yesterday start the thesis Apple on the services side. The figures show that this is only the beginning of Muskade's monetization. The bears should go back into hibernation mode after reading this narrative over a gloomy setting. He continued, it's no secret that Dan Ives is a Tesla bull. As you're all aware, the news of Tesla's collaboration with Ford and GM was positively received. A few days ago, Tesla shares reached a new 8-month high when the company revealed that it will allow General Motors electric vehicles to use its supercharger network. This announcement follows one for Ford EVs and represents a significant opportunity for Tesla to make money. In a recent note to clients, Wedbush analyst Dan have raised his price objective for Tesla by 40 to 300 at the moment. Where are we on the price roadmap cuts in terms of Tesla, which Elon Musk is clearly a move to put, growth ahead of profitability. Yeah, and I think that's been the right poker move, and I think it's paid off significantly, especially in China. I think now of 95, 96 of those cuts, we think in their Brain America, and I think you saw maybe some overreaction last week, and you definitely seen a rebound as I think more investors are recognizing that. But right now, margins suffering at the cost of units. Now I think that drops over the next quarter or two and starts to rebound into next year. And that's the yin-yang that they're going to strike. But ultimately, it continues to be Tesla's world and everyone else is paying rent in terms of overall EVs. I think that's becoming clearer and clearer in a note to clients' Ives called Tesla. Golden Eve's success story, he highlighted the growing adoption of Tesla's supercharger network and added, we expect more names such as Hyundai, Honda, Acura, and other large OEMs to follow suit. Well, some actually did a long line of rival automakers have thrown in the towel and agreed to join Tesla's supercharger network. The first to defy tradition was Ford Motor Company back in May. General Motors and Nissan were soon after, and a number of other automakers quickly followed suit, including Volvo's Polestar, Mercedes-Benz, and Nissan. In light of this, Tesla is expected to receive up to $20 billion in revenue from its recent supercharge through deals with Ford, General Motors, and various other automakers, according to a recent note from Dan Ives of Wedbush. It is worth noting that Tesla is also working to secure its share of the $7.5 billion in U.S. government subsidy cities designed to accelerate the installation of as many as 500 high-speed chargers on the country's busiest highways. The Biden administration has been clear that Tesla would only be eligible if other automakers were granted access to its network. Spending on Tesla's supercharger network has been significant, with charging stations costing a hefty $42,000 per connector, the resulting financial burden. Side Tesla stations are much more cost-effective compared to the 100 to 250 per connector spent by rivals, according to a report. So in terms of the stock, it's up 10% this week. It's down 10% over a month. And the reason, I'm trying to get the correlation here between it and the NASDAQ if the NASDAQ continues to have some trouble. And big tech in general pulls back, this stock is going to be susceptible to that as well. Don't you think? Of course, yeah. I mean, will we continue to view Test? It's a disruptive technology company, not an auto player, right? But it's our view during the second half of the year. I think tech stocks rip high. I mean, it's my view that the new tech full market has already begun. I think growth is going to exceed street expectations. I've spoken with NVIDIA, but the app is powder, I believe. Tesla's supercharger network is undoubtedly the most extensive and robust on the planet. And earlier this summer, it gained massive attention when it struck deals with various OEMs to allow their ES to access the charging infrastructure starting in spring 2024. And this is what we're going to see with this trillion-dollar tidal wave of spend for players across the tech ecosystem. We analyzed and projected out Tesla's supercharger network, taking into consideration access and revenues from other OEMs using stations around the United States. In another communication to investors, I advised them to go deeper into this sum of the parts valuation. In the end, we predict that Tesla's supercharger business will account for 3 to 6% of overall sales, or between $10 billion and $20 by 2030. While the supercharger network's opening to OEMs is a significant aspect of the Tesla story, IVES noted in the note that there are other aspects as well, such as the company's strong production numbers, thriving energy business, ongoing advancements in the development of autopilot, and a fully autonomous and unrivaled battery ecosystem and expanded production and scale scope, all of which contribute to Tesla's strong financial sheet. As part of the government's objective to reduce carbon emissions to zero by 2050, we believe Tesla is in a perfect position to further benefit from the EVES revolution. I've stated, to put it simply, that he is a strong supporter of Tesla and that the company is in a great position to profit from its success now that it has built its EV castle. He cited the company's growing capacity to generate revenue from sources other than EV sales. Tesla is expected to get an additional $3 in income from Ford and General Motors electric vehicle users. I've said that Tesla had committed earlier in the year to expanding its network to include 7,500 superchargers by 2024, more than tripling its present capacity of about 5,000. He predicts that the growing volume of agreements with other automakers would quicken its expansion. Tesla's network is almost entirely solar powered, so the energy generation costs negligible. As a result, Tesla's supercharger network will represent a large monetization opportunity and account for roughly 3% to 6% of total revenues, translating to a $10 billion to $20 billion business. By 2030, according to IVES, this implies that Tesla stands to generate total revenue of more than $330 billion. By the end of the decade, across rolling business, hefty increase from the $94 billion. It reported over the trailing 12-month period. A few weeks ago, IVES gave Tesla stock a buy. His price target is $350 a share, one of the highest on Wall Street. That worked out to about 73 times his 2024 earnings estimate of 4.80 cents a share. Overall, 39% of analysts covering the company rate shares by now. It's pause, pullback, whatever you're going to characterize that as. I mean, what do you want these stocks to go up 60 and 70% for the year? I mean, my view is first away overcorrected last year. I mean, that's our opinion. And I think now investors more and more going to 2024, 2025, looking at a cycle that we haven't seen in 30 years now. Of course, rates as you have to professor, that's clearly going to be a headwind. But when I looked across PAC, when I look across software cybersecurity chips, I view this as a time where we view it as a star of a new tech bull market, not the time where we're hiding because of valuations. I think these stocks throw into their valuations over coming years, raising his price target for the EV maker to 350. IVES argued in a note that Elon Musk's company has demonstrated that it can monetize key products, including its supercharger network and self-driving tech. Tesla is currently trading at around $250 per share, 100 short of IVES' price target. Unsurprisingly, Tesla bears do not share IVES as optimistic about Tesla stock, particularly considering that the company's shares have been declining since it released its earnings in July due to worries about declining margins and ongoing price reductions. Despite this, the company has still increased its value by more than 90 for the year, and its growth is just getting started. IVES really thinks IVES went on to say that the reason the Tesla bears are negative is because they see Tesla as a car company. He, on the other hand, is still extremely bullish about the company's outlook because, like Cathie Wood of ARK Invest, he sees the company as a major player in the tech and AI space. As I've said before, I've always viewed them as a tech play, and I can argue that the FSD angle makes them one of the best AI plays when you look 3 to 5 years into the future. As a tech company, Tesla will make money through the monetization of some priceless services. I've stated the company's supercharging network marks the start of this revenue stream. Last Monday, IVES and his team unveiled updated predictions regarding the Tesla supercharging network, claiming that by the end of the decade, the network may generate up to $20 billion in an income annually roughly 6% of Tesla's overall. This most recent model is predicated on the assumption of wide adoption, with IVES projecting that EVs will account for almost 20 of all automobiles by the end of the decade, up from the present ratio of 3 to 4. There are numerous variables. According to IVES, the majority of Model 1 charging now takes place at home or at a place of work. This suggests that more EVs are being utilized for purposes other than commuting and are charging over long distances. Don't forget to subscribe for more.